$500 silver is not a meme number. It's what happens when a 45-year bear market ends, the currency system breaks, and a physically short market finally has to settle up at real prices. OG John AG here. Today we're not talking about some upside in silver. We're talking about the exact chain of events that can turn this market from an annoying sideshow into a 3-digit, then 4-digit shock, and why $500 silver is the logical outcome of math, not magic. We're going to walk through how we came out of a multi-decade bear market into a hard money super cycle, what money printing, shadow bailouts, and de-dollarization actually do to silver, why the world has run a structural silver deficit for 6 straight years, why COMEX and London vaults are quietly running on fumes, how China's export controls and industrial demand turn a tight market into a crisis, and finally, how the path to $500 silver actually looks when you run the numbers on gold, the ratio, and the paper leverage built on top of 1 single ounce. No hype, no hopium, just structure, perspective, 45 years of pain before the real move. Before you even say $500, you need to understand where we came from. Silver has basically been in a 45-year bear market. The last full mania was 1979, 1980, the Hunt Brothers episode, and everything since then has been fits and starts inside a larger down to sideways regime. Generations of investors were taught that silver is dead, irrelevant, poor man's gold. That conditioning is exactly what you want to see before a regime change. Think about what's changed since then. Multiple fiat currency crises, derivatives piled on top of derivatives, a sovereign debt problem measured in hundreds of trillions, a digital, electrified, AI-driven economy absolutely addicted to silver as an industrial input. We are not in 1980 anymore. The market that's coming is not a repeat of that spike. It's the end of a 45-year sideways stretch where the price was artificially suppressed while the need for silver went vertical. When decades of suppressed price meet a broken currency regime, the move is never reasonable. It's violent. Wave 1, currency debasement, money printing, and hidden bailouts. The first big wave in this story was currency debasement. Every time the system hit a wall, dot-com crash, GFC, Euro crisis, 2020, central banks responded the same way. Slash rates, print money, bail out the same leverage that caused the problem. That's the official story. The unofficial story is the secret liquidity. Dollar swap lines, repo facilities, alphabet soup programs, and emergency injections that never make it to the front page but show up in Fed balance sheet data if you know where to look. All of that has one effect. It tells you the currency is not a store of value. It's a political tool. Gold reacts first to that. But silver is the leverage on that story, and the more the system leans on money printing and under-the-table bailouts, the more pressure builds under silver as the high-beta monetary release valve. If this were just about rates or one QE program, we wouldn't be having a $500 conversation. But this is about a quarter-century of non-stop intervention and a debt load that can never be paid back in honest money. De-dollarization and the BRICS unit, new money, old metal. Next layer, de-dollarization. We now have BRICS countries openly building alternative payment systems and talking about a commodity-linked unit for trade, sometimes referred to as a BRICS unit. Whether that exact branding sticks or not is irrelevant. The direction is what matters. When large economies decide they no longer want to settle trade in dollars, they have to anchor trust somewhere else. That somewhere is real stuff: oil, gas, grain, gold, and increasingly silver, because it's both monetary and industrial. This trend does 2 things at once. It weakens the dollar's monopoly as the global unit of account. It forces central banks and sovereign funds to hold more tangible collateral. Gold sits at the center of that shift. But silver, with its smaller market cap and dual role, becomes the high-octane kicker. In a world where trade blocs are building a new unit of value around commodities, silver stops being a side character and starts being part of the core collateral stack. That's not bullish for $30. That's bullish for repricing the entire silver complex. 6 years of structural deficit. The shortage you can't see on a 5-minute chart. Now to the part very few people talk about properly: structural deficit. We are now more than 6 years into a global silver supply deficit. The market has been consuming more silver each year than is mined and recycled. This isn't a one-off year of tightness, it's a structural trend. When a commodity runs a deficit year after year, you have only 3 ways out. Raise the price high enough to slow demand, raise the price high enough to incentivize new supply, or drain inventories until you hit a wall and are forced into rationing and substitution. The silver market has been cheating the process using option 3, drawing down above-ground stocks, ETF holdings, and vault inventories. On paper, this lets the price pretend everything is fine. In reality, you're eating your seed corn. 6 years of deficit is not just a statistic, it's a countdown. COMEX, London, and the inventory mirage. That brings us to the visible part of the iceberg: COMEX and London. COMEX registered silver has been sliding. London vaults tracked by the LBMA have been draining. More and more of the remaining inventory is earmarked, hypothecated, or otherwise spoken for. On the surface, you still see big headline numbers, hundreds of millions of ounces, but the slice that is truly available, not double counted or tied up in long-term deals, is shrinking. At the same time, the paper open interest stacked on top of that metal is enormous. In some cases, you're looking at effective leverage of hundreds of ounces of paper claims for every ounce of actual deliverable metal. As long as most players roll their contracts and never ask for bars, the illusion holds. But once enough people say, no, I want delivery, the system has two choices. Find real metal fast, at much higher prices, or pay cash to make people go away and hope no one notices. That's how you get price gaps, not polite uptrends. That's how you get one of the core ingredients for $500 silver. Mining's dirty secret. You can't just turn up supply. Now imagine you're running a mine. For 10, 20, 30 years, the silver price has been mediocre. You've been underinvesting, high-grading your best ore, and surviving on razor-thin margins. Then suddenly the world wakes up and starts screaming for silver. Can you just flip a switch and double production? No. It takes a decade plus to bring a new major mine from discovery to production. Environmental approvals, permits, political risk, capital costs, all of that has exploded. A lot of silver is produced as a byproduct of other metals like lead, zinc, copper, so even if silver price mooned, primary output doesn't follow 1-1. That's the dirty secret. The supply side is not elastic. The industry has underinvested for decades, and it cannot respond quickly. At some price, yes, more projects move from uneconomic to go. But to rescue a 6-year deficit, refill inventories, and satisfy new industrial and monetary demand, the price doesn't just need to be good. It has to be absurdly good. That's how you justify talking about $200, $300, even $500 silver, not as a fantasy, but as the level needed to reboot supply in a structurally broken system. The China shock, export restrictions on refined silver. Now overlay China. China has started restricting exports of refined silver. Not ore, not vague promises. Refined silver, the stuff the rest of the world wants to import. Why would they do that? Because they see the same deficit. Because they need silver for their own industries. Solar, EVs, electronics, AI hardware, and they're not interested in subsidizing Western underpricing forever. When a major producer or refiner starts limiting exports, it does two things. Tightens global supply even further, sends a signal. We value this metal more than the current global price. It's the same pattern you see in food crises when countries ban grain exports. They stop being participants in the global price and start being hoarders. Now imagine that behavior spreading, more export controls, more nationalization of strategic mines, more resource nationalism contracts where foreign buyers get less and locals get first dibs. That's not a $30 story. That's a you'll pay whatever we say story for anyone who doesn't control their own supply. Industrial demand explosion. Solar, EVs, AI. On top of the monetary story sits the industrial explosion. Silver isn't just shiny. It's the best electrical conductor we have, a core element in high-efficiency solar panels, essential in EVs, charging infrastructure, advanced electronics, and a lot of AI-related hardware. Every time we electrify another piece of the economy, we add incremental silver demand, more gigawatts of solar capacity, more silver in photovoltaic cells. More EVs, boxers, more silver in circuitry, more data centers and AI servers, box more high-end electrical components. You cannot 3D print a substitute for silver's conductivity. You can thrift it, stretch it, try to use a little less, but at scale, the total volume goes up, not down. So on one side, you have nations and investors treating silver as hard money. On the other side, you have an industrial system that will not function at current scale without it. When a metal is both money and irreplaceable input, price caps don't last. They snap. Silver versus gold, consumption versus hoarding. Here's a key difference that matters when you start throwing around numbers like $500. Most of the gold ever mined is still above ground in some form. Bars, coins, jewelry, central bank vaults. Silver is different. A huge portion of historical silver production is gone, sitting in landfills built into old electronics, worn away in industrial processes that are uneconomic to recycle at low prices. So while gold acts like a classic monetary hoard, silver is constantly being consumed. Gold, stock to flow is huge. Lots of above-ground stock versus annual mine output. Silver, stock to flow is much tighter. Not nearly as much easy to mobilize above-ground inventory relative to what we use each year. That's why when the monetary bid collides with industrial demand in silver, the move is more violent than in gold. Gold reprices the system. Silver blows the hinges off the door. If gold goes to 8,000 or 10,000 in a real currency reset, silver doesn't have to behave. It can overshoot far beyond traditional ratio models because the consumptive side refuses to show up at any lesser price. Wall Street's paper game, 3 and 65 contracts for 1 ounce. Now we come to the engine room, derivatives. For years, Wall Street has been playing a paper game with silver, stacking more and more futures, options, and unallocated promises on top of a shrinking physical base. In some structures, you can be looking at hundreds of paper ounces for every real ounce available. In the video, this is simplified as 3 and 65 contracts for 1 ounce. 1 contract for every day of the year on top of a single ounce of metal. Whether the exact number fluctuates month to month is less important than the principle. The leverage is insane. As long as everyone treats silver as a token to be traded and rolled, this works. But the second enough players demand physical settlement, or the second some critical vault cannot deliver, the whole pyramid gets repriced. What does repricing look like in a highly leveraged, thinly stocked market? Short squeezes, gap moves, trading halts, and prices that jump not 5% or 10%, but 50%, 100% multiples. That's not hyperbole. That's how leverage works when the underlying collateral is scarce and non-printable. The path to $500, gold, ratio, and forced repricing. So how do you go from here to $500? You don't get there with silver up 2% a year. You get there with regime change. Gold reprices higher as currencies are debased and debt is inflated away. Think gold in the 8,000, 10,000 range in a real reset. The gold-silver ratio compresses aggressively as silver's dual role, monetary plus industrial, kicks in, dropping from current levels toward 30, 20, or even lower in a panicked phase. Paper leverage breaks when enough entities demand physical delivery, forcing shorts to bid whatever it takes to close positions or find bars. Export controls, mine disruptions, and industrial bidding wars mean no one wants to sell real metal at old prices. Run a simple scenario. Gold at 10,000. Gold-silver ratio at 20. That alone prices silver at 500. Is 20.1 crazy? Not in an extreme stress event. Historically, the ratio has been far lower than today in past manias. And that was without this level of industrial dependency and without a 6-year structural deficit. Could it overshoot? Yes. Could it fail to get there? Also yes. But the path is not fantasy. It's baked into the relationship between gold's revaluation, silver's scarcity, the paper stack built on top, institutional positioning in mining stocks, the leverage on the leverage. Finally, understand how institutions see this. Option flows, structured products, and institutional positioning in metals already show a quiet shift. Longer dated calls. Out of the money structures that only pay if silver moves multiples. They don't buy those if they think silver is just going from 25 to 30. Then you have mining stocks, especially primary silver miners, trading at valuations that assume silver remains cheap forever. If you start feeding $100, $200, $300 silver into those models, the equity leverage becomes insane, but that's a double-edged sword. Management risk, jurisdiction risk, cost blowouts, dilution. The lesson from the 1979 mania still stands. Physical metal is your base. Mining stocks are leveraged speculation on top of that base. You don't start at the leverage, you graduate to it. Closing. What $500 silver really represents, $500 silver, is not just a price target, it's a diagnosis. It says, fiat has failed, debt has been inflated away, the world chose real assets over promises. The 6-year deficit, the drained vaults, the export controls, the industrial hunger, all of it finally showed up in one number. Your job is not to worship that number. Your job is to understand the structure that makes it possible and to position yourself in a way that doesn't blow you up if we stop at $80 or $150 or overshoot to levels no one dares say out loud. This is financial warfare education, not advice. Do your own due diligence. Protect your capital. Size your bets as if you can be wrong, because you can. If you're still here, tell me in the comments, what's more unthinkable to you, $500 silver, or the idea that this broken system somehow keeps silver at 25 forever? And if you're one of the few who watches with your brain turned on, drop OG John AG down below so I know who you are. OG out.